Hello guys, welcome to Smart Money Trading course. Hope you all doing great. In this video I'm going to cover market structure. Market structure is the most vital topic and the most important aspect of trading. You must keep this in mind. Once you master the proper structures in the market, all the structural breaks and minor and major structures, it really helps you in detecting the trends of the market and detecting the proper order blocks and how you set your limits, your take profit levels and stop loss level. So I must say that it takes a lot of practice. It takes days, months or maybe years to master market structure properly. So you must be consistent, you must be patient and you must practice a lot. So what is market structure? Market structure refers to the way in which a market is organized and operates. So market structure is actually the nature in which the market is moving, and a lot of beginner traders do this mistake. They jump directly to understanding the confluences or various technicals without learning the market structure properly. So it is very important that you understand the market structure and you practice market structure a lot before going deep into smart money trading concepts. And the most important factor which determines the market structure is the number of buyers and sellers. So when the number of buyers is higher than the sellers, the market generally tends to move higher, creating higher highs and higher lows. And when the number of buyers is equal to the number of sellers, it creates a consolidation. It creates a ranging market, and when the number of sellers is higher than the number of buyers, it creates more supply of the asset or product, you may say, and the market goes down. So there are three types of market structure, and the most important factor which determines the type of market structure is the number of buyers and sellers. There are three types of market structure: bullish market structure, bearish market structure, and ranging market structure. So coming to the bullish market structure. When the market is uptrending, that is, the market is creating higher highs and higher lows, higher highs and higher lows, higher highs and higher lows, it is generally called as bullish market structure. As a trader, if I ask you, how could you detect when the market is creating this low, this high, this low, this high, this low, this high? You could see that as the market is creating this low, the next low is higher than the previous low. And when the market is creating the next high, it is higher than the previous high. So in a bullish market structure, the market is creating higher highs and higher lows, higher highs and higher lows, higher highs and higher lows. Structural break to the upside. So when there is a structural break to the upside, you generally call it a bullish market structure. And the low is not broken. Let's see it clearly here. There is low, but the low is not broken. So this is what it is. It is a bullish structure when the market is moving up, creating higher highs and higher lows. And there is a structural break to the upside. The next high is breaking the previous high, creating higher highs, and the next low is above the previous low, creating higher low. So this is what bullish market structure is. Next comes bearish market structure. What is a bearish market structure? It is just the opposite of bullish market structure. When the next low is below the previous low and the next high is below the previous high, it is a bearish market structure. If this is high and this is low, you could see that the next high is below the previous high and the next low is below the previous low. So there is structural break to the downside. There is structural break to the downside. And the next low breaks the previous low. There is no structural break to the upside. There is no structural break to the outside. And the high doesn't breaks the previous high. This is what bearish market structure is. And the next type of market structure is ranging market structure. So what is ranging market structure. When there are equal highs and equal lows in the market and the highs or lows doesn't break the previous high or low, it is generally considered as a ranging market structure. So what is a ranging market structure? This is high, this is low, this is high, this is low, this is high, this is low. The lows do not break the previous lows and the highs do not break the previous high. So it creates a range like this. This is a ranging market structure. So I hope that you have understood the basics of market structure clearly, and I'm going to show you from live charts the basics of market structure and the various types of market structure, that is bearish, bullish and ranging. Let's come to the live charts. So now I'm going to show you from live charts the three different types of market structure. So you can clearly see here that the market has come down, created this high and again created this low. But this low has not yet been broken and this high has not yet been broken. The high got broke but did not close above this high. So you could clearly understand this zone to be a consolidation zone. The high did not close above this high and the low did not close below this low. And it lasted for nearly 87 days. So it's a big range of consolidation and it come back to test this level of support and finally it break this level of resistance with a strong bullish candle creating higher high. So this is high, this is high, this is another high, and this is low, this is another low. And as it break this high, there is a natural shift in direction. The market moved down, created a level of consolidation and then broke this level of high. So you could see here that as it broke this level of high, there is still a low here and it did not break this level of low, and then it again broke this level creating higher high. So this is high, this is higher high, this is low, this is higher low. So you could clearly see here that this market structure is trying to go up, creating uptrend in the market, and as there is uptrend in the market is constantly making higher highs and higher lows, and then again higher high, breaking this level of high, and again another higher low. This is another higher high, this is another higher low. Again the market broke this level of high with a strong bullish candle. There is another higher high and another higher low. Again the market broke this level of high with another higher high and another higher low. And as you could see here, when the market reaches this price point, it did not create another higher high, and there is a natural shift in direction from this higher low. What happens next is that it breaks this level, it breaks this low, creating lower low, and it did not break this lower high. It is a higher high, you could see here. It is another high, but this high is lower than this high. So there is a shift in direction from uptrending market to downtrending market. And how you could identify this? The low gets broken, and as the low gets broken, the market creates lower lows and lower highs. This is higher low, and this low is broken by this low. So this is lower low. For this change in direction or shift in direction, you mark this low as simply low and mark this high as simply high. And what happens next is that it breaks this structure, creating lower low. And as it creates lower low, and this is the last lower high. As this low is broken by this low, there is another lower high here. This low gets broken by this lower low. Again, this low gets broken by this lower low. And again, there is a shift in direction and the lower high gets broken. So you could clearly understand how you could detect this market structure from live charts. And now I'm going to show you the major and minor higher highs and higher lows. Hello guys, now I'm going to show you the technical terms, and these two technical terms are very important in determining the market structures. There's a BOS, that is breakout structure, and CHOCH, that is change of character. So what is BOS? BOS is a technical term which helps in identifying a structural break in the market, generally confirming a trend. So when the market moves like this, in an uptrending market, like this, what it naturally does is that it breaks this high, creating higher high, and again it breaks this high, creating higher high, and again it breaks this high, creating higher high. So when the high gets broken and creating higher low, and again the high gets broken, it causes a structural break in the market of this high, and generally confirming that yes, it is an uptrending market. So this break of structure towards the upside is called the break of structure. So you generally identify this as BOS, that is break of structure. And in a downtrending market, it is just the opposite. What happens is that low gets broken, is generally the lower low, and again the low gets broken here, and again the low gets broken here, and again the low gets broken here. This is a break of structure towards the downside. So you could see that breakout structure is just a technical term. So breakout structure is confirming that yes, it is breaking the higher previous high, creating another higher high. So there is a structural break of this high, creating another higher high. So this confirms that yes, the market is uptrending, and the breakout structure in the downtrend generally confirms that yes, it is downtrending, and the low gets broken by the next low, creating lower low. So a market breakout structure generally confirms that yes, it is a trending market, and there is no breakout structure in a ranging market, because there is no breakout structure either to the upside or to the downside. So it's creates equal highs and equal lows, equal highs and equal lows. There is no breakout structure either to the upside or to the downside. Next, we come to change of character. What is change of character? When there is a shift in market from an uptrending market to the downtrending market, or from the downtrending to the uptrending, we call this a change of character. So what is a change of character? A technical term which helps in identifying the shift in direction in a trending market. So the market is uptrending like this, and when it is uptrending, it is creating higher high and higher lows, higher high and higher low. As you could see here, this low gets broken by the next low. There is higher high, there is higher high, so there is a structural break towards the upside, and at this position the higher low gets broken by the next low, creating lower low. So when there is a shift in direction, either from upside to the downside or from downside to the upside, we call this a change of character. So this is CHOCH. This is change of character. Change of character helps in determining the shift in direction or reverse in direction of a trending market. This is from uptrending to downtrending change of character. And next I'm going to show you downtrending to uptrending change of character. This is a change of character to the upside. So I think you have clearly understood the breakout structure and change of character, and these two are very important in determining market structure. So going back to the live charts which I have shown you recently, this is a ranging market and there is no breakout structure either to the upside or to the downside. And this, you can see here that the market is creating, and you could see here that the market is coming down, breaking this low, and again consolidates for 87 days, creating equal highs and equal lows, creating equal highs and equal lows, and did not break either this high or this low with a proper bullish or bearish candle. But at this point the market structure reverses. It comes down, consolidates, and then it reverses. So we can mark this as change of character, because you could see here that the market is creating high, low, lower high, lower low, lower high, then ranges, same equal highs, it is creating equal highs and equal lows. And what it does next, it comes down, consolidates, and then shifts its direction and creating higher highs. So there is a change of character because it is shifting from downtrending to uptrending. So it is causing a change of character, and there is higher high and again higher low. And here comes breakout structure, confirming that yes, it is uptrending. And again it is causing another breakout structure, and again it is causing another breakout structure to the upside. And what it does next is that after creating this low, it causes change in direction to the downside. So when it reverses or shift direction from creating higher highs, higher lows to lower highs, lower lows, we call that a change of character. So we call this CHOCH, that is change of character. And after causing this change of character, what it does next, it confirms that the market is getting bearish, creating lower highs and lower low. And after creating this lower low, it is again causing breakout structure to the downside. And here again you could see another breakout structure to the downside. And after causing this breakout structure and this low, you may say, what you see is that it again shifts in direction, causing change of character. After this high and after this low, it shifts in direction, causing again change of character. So it goes on and on and on. Either it shifts direction, or it consolidates, or trends at a particular direction. So this is what change of character and breakout structure is in a trending market or in a consolidating market. And I have shown you how the change of character and breakout structure plays out in three different types of market structure, that is bullish, bearish, and ranging. Hello guys, now I am going to explain to you major and minor structures. This topic of major and minor structure in market structure is a very important topic, and when you fail to detect these major and minor structures, you make mistakes in identifying the proper order blocks or point of interest, which I will cover in the next sections. But now I'm going to explain to you the major and minor structures. What you see is that when the price moves like these, suppose in 3-day time frame or 4-day time frame, you mark this as low, this as high, this as lower low, and this as lower high, and again this as lower low. But when you go to 1-day time frame or 2 hour or 1 hour, you don't see these clearly, and as a result of that, there are many students who make this mistake in detecting the major and minor structures. So to detect the major structure, you go to the higher time frame. If you trade 15 minutes, go to 1 hour, 2 hour to detect the structures in the market and the major highs and lows in the market. And when you trade 1-day time frame, you go to the major structures such as 3-day time frame, 4-day time frame, or maybe 1 week. So this helps in detecting the trends in the market and the proper structures in the market. Unless and until you detect the proper structures in the market, you take wrong trades. Now I'm going to show you how major and minor structures are very important. So as you see that the market is moving like this in a downtrending market, when you go to lower time frames, the market doesn't actually move like this. The market creates this high, creates this low, and again does this, what most of you do is that when you see this structure, this high replicates this high, this low replicates this low, this high replicates this high. But as a beginner trader, what most of you do is that you identify these as the next lower high, but this is actually wrong, and this comes with practice. I will say it again and again. Initially, when you mark these structures, when you mark the highs and lows, you will make mistake. I did the mistakes too, but as time goes, as you gain experience, as you gain confidence in the market, as you practice a lot, you identify the proper structures in the market. So this is a major structure and this is a minor structure. These are the big waves and these are the small waves in the market. When you zoom this structure, you could actually see this type of structures in the market. So, and the big waves are very powerful. So there is a rule of the market that when you trade, you always trade with the trend. So as you see that the market is moving down, creating major low, high, lower low, and lower high, as a beginner trader, I will always advise you to avoid the uptrend here. When you see an uptrend here, you think that it is breaking this level, it is breaking this high. And when you see that the high is broken, you go for long at this position. And most of the trades are very risky at this position for long. But as you gain experience in the market and you identify the proper structures in the market, you wait for the order blocks here, you wait and you trade from here. So as a trader, it is very important to identify the major and minor structures. This is the case of a downtrending market. Now I am going to show you same case for an uptrending market. You see this, but actually the market doesn't move like this. You see at lower time frame. So these are very important and these are very interesting too, that you identify the perfect order blocks. So you wait for the price to come back to this order blocks. Even if it is a downtrending, you know that the major structure is bullish. So wait for the order blocks to be tapped and then put your limits or orders here and you wait for your entries. Many of you may rush when you see a break of structure to the upside here. And you think that if the price doesn't come to this zone, you place your orders here and doesn't wait for the price to come back to this zone. And when you rush your trades here at this point, what happens is that you enter at a fake change of character. What you must do is that you wait for the price to come to this order block, discounted zone, and you then wait for this change of character instead of this change of character. When you enter at this change of character, you enter a fake trade and your stop loss gets hit. Instead, you wait for this unmitigated zone or this order block and you wait for this change of character and then the price to come back to this order block, which is responsible for this real change of character, and then place your trades here so that you enter a proper trade and you win. So this is how the major and minor structures are really important. You have seen in many of my analysis that I have marked that as major structures and minor structure. Because this is a major structure, major high, even if there are minor highs or minor change of character here, I don't take the trades. I wait for the price to come back to this zone. Then a change of character here and then enter my trade. Now I'm going to show you the major and minor structures. Here what I have marked are the real major structures. These are highs and these are lows. This one is high and this one is low. And once it breaks this high, it creates another low. And as it creates this low, you could see that there are many minor structures. And how could you detect this? This is a high, this is a low, this is another high in lower time frame, this is another low, and this is another high. So this is another low, this is a minor structure. As it breaks this low, it is creating minor lower high, minor lower low, minor lower high, minor lower low, minor lower high, and minor lower. It doesn't create another low. Instead, it creates another lower high and it breaks this high. So this is a minor structure. This is a minor structure which gets broken. This is a minor structure which gets broken here. This is another change of character at lower time frame. This is a massive breakout structure to the upside. So you can see that even if it is uptrending, it is creating a downtrend in lower time frame, and this is very important. This is very important. Even if the major structure is uptrending, you can see it is creating minor uptrend and minor downtrends. So you could see here, this is uptrending, creating in minor low, minor higher high, minor higher low, and again breaking this, reverses in direction and lower high, lower low, lower high, lower low, again changes in direction, higher high, higher low, higher high, higher low. These are very important. You might think why I am showing this, but no, these are really very important, and in the coming videos you will come to understand how these are so important. Higher high, higher low, higher high, higher low. Again changes in direction. It changes in direction, creating higher high, higher low, higher high. And now I'm going to show you in a downtrending market to detect the minor structures. So this is major low, major lower high, and it is creating this lows, this high, this lows, this high, and again breaking this structure, creating this high, creating this low, and another higher high, another higher low, again another higher high. I'm marking this for your convenience. These are minor. All these are minor structures, but these are not important. What most of the traders, what most of you fail is that you mark these highs and lows, and take these trades, and for that reason you lose most of the times. But these are not the real structures when you trade swing. When you trade swing, when you go for higher time frame trades, you see. So you wait for major highs, you wait for major lows. You see the major structures. And once you see the major structure, for these order blocks to be tapped in major structures, not in minor structures. When you see these structures and you trade, you go for uptrend, you think that the price will go up and up and up, but the major structure is downtrending. So this is very important. I am saying you again and again. Once it taps to this zone, it rushes to create another low. So you can see here that it is creating lower high, lower high, lower high, and then broke this low, creating lower low. Lower high, lower low, lower high. Did not break this low, now another higher high. If you think that this is a proper order block, this is not, because what most of you have done is that you have made a mistake in seeing this minor structure and thinking that this is the trend of the market, but this actually not is. These are just minor structures, and this helps in creating more liquidity for the banks. Yes, this is very true. It helps in creating more liquidity. So this got up and again comes down, creating another lower highs, and then it finally changes direction and then shoots up. So I think you have understood how major and minor structures are different, and how it is very important in detecting the proper trends in the market. And the most important point you must remember is that always trade with the trend. So always trade with the trend of the major structures. Don't trade when you see bullish or bearish in just minor structures. When you see that the market is bullish in higher time frame, that is the major structure is bullish, and you could simultaneously see that the minor structures are bullish too, then you take the trades. Otherwise, don't trade. It is always better not to trade than to trade wrong trades. So I think you have clearly understood the market structure, the three types of market structure: breakout structure, change of character, and minor and major structures. You practice these structures a lot, and I think when you master the market structure properly, you move on to the next topic. So this is the end of market structure. See you in the next video. Until then, peace.